Simon, welcome to our monthly market update for the month of August. And yes, always interesting month, but every month is just that much more interesting than the month before.
Do you know it's been a wild year?
Yes. And we've seen a lot of firsts. So, the S&P and NASDAQ hitting all-time highs, record highs. So that has been really put us firmly into uncharted territory in terms of the questions around when is the correction happening, and we're all sort of jittery and expecting this moment where it'll all come crashing down. And as some of us are ETF holders of these kind of we hold ETFs that track the S&P 500, MSCI World Index, which earlier this year had a nice big fat crash in Feb due to a massive sell-off by investors of equities. It has since picked up with a couple of sell-offs in between, but it's pretty much almost not too far from those highs that we saw at the beginning of the year. So we're seeing equity markets steadily sort of come back, and then with the occasional drama when Trump tweets something and everyone sort of like scricks and sells things, and then 2 days later they're back at it. So we do indeed live in interesting times, but navigating these times is a bit tricky. And we can't predict anything, but how should one navigate this incredibly new phase and era of markets?
Okay, let's start with the easy questions. Short answer, if you're an ETF investor, the beauty of an ETF investor is you're buying a basket, and indices are by their nature designed to go up. And there's two reasons why an index by its design feature goes higher. One is just inflation. If you're running at 5% inflation, on a straight line, a company should increase growth by 5%, and therefore profits, and therefore dividends, etc. Of course, we expect the companies to be efficient and to be able to do better than that in the good times, and worse in the less good times. The other key thing with those indices is that the loser stocks get kicked out and the new winners come in. So, for example, African Bank was in the top 40, got booted out at about 32 Rand and went to zero. Capitec came in at about 500 and is now 1,000. So it's that sort of self-correct. So as an ETF investor, you hopefully have monthly debit orders that go off initially 33,000 into your tax-free every year, the rest, and you just carry on doing it. You just carry on doing your money aside. Debit. And at some point markets will fall, and that's like when Woolies has a sale and things are cheap, and you carry on buying. You get more bang for buck. Of course, what happens, it depends if you're on offshore ETFs, and if we go back to 2008, US markets fall, ZAR falls, and your impact on the US or the MSCI global indices
is that much more
is less pronounced because of the ZAR weakness in the process. That offsets not all, but certainly some of the downside that happens in the ETFs. When does it end? A couple of things. So this market started in March 2009. I remember I was on the trading floor, Standard Bank, the night before. Bernanke had mentioned green shoots, and we were basically, the view was that Bernanke was stupid. Turns out Bernanke knew exactly. Now he started, and here we are 9.5 years later with the longest bull market in US history. In other words, there hasn't been a 20% pullback at any stage in the last 9 years, which is a staggering stat. S&P at all-time highs, NASDAQ at all-time highs, Dow Jones just off all-time highs. But when we drill into it, and if we look at, and let's look at the US economy, and let's put the politicians to one side. Record levels of unemployment, record levels of consumer confidence. Consumer confidence came out last week at the best level since 2000. Tax cuts, which haven't trickled down as they never do, but to a little bit. Equity markets at all-time highs, which means Americans, when they look at their 401k plans, equivalent of our retirement annuity, are richer on paper, leading through to that confidence. So this bull market will end, guaranteed. We are probably, almost certainly, closer to the end of it than we are the beginning. In other words, it's unlikely. Yeah, we're past the halfway mark, because it's unlikely that this bull market is going to be 19 years in duration. Not impossible, but I wouldn't put money on it. And what's going to kill the bull market, and we've discussed this before, is rising interest rates. And the one to watch is the US 10-year. 286 when I looked at it earlier this morning. We're recording Monday 3rd. And everyone's saying that 4.5 is the big number. That when it starts to get to 4.5, we're in trouble. We
should worry.
And we're still probably at least a year to year and a half, if not longer, away from that. But the thing is, is what not to do is to start to say, well, Simon just said maybe a year or year and a half, let me start selling, because I could be totally wrong. This could end up being a 17-year-long bull market. The retrace could just be a slight pullback of 25% and then a year of sideways. I mean, we don't know. So what do you do as an investor? Is you constantly buying ETFs. If you want to do some DIY, you're buying quality shares. You've also then perhaps got some small caps, mid caps, second tiers. Watch those, but watch the stocks, watch the earnings, watch the price. Don't try and look at a big picture and find reasons to bail, because in the last 10 years, there have been probably 100 really strong reasons why this bull market was open. Folks who are old enough will remember post the 08-09 crisis that it's going to be a double dip, and it wasn't double dip. It will at some stage pull back. There's a great chart that pops up every so often. It's the S&P over the last decade and all the reasons why you should have sold, all the crises. Those crises include Greek defaults and China RMB manipulation and so on and so on. Brexit, Trump victories. Literally 100 reasons in a decade to have sold, and yet the market carries on going higher. And we're just closing out Q2 of earnings in the US. It's going to be the biggest growth in earnings since 2010. It's going to be the strongest quarter of earnings ever. Something will blindside this market. Something will send it tumbling. It might be happening as you're listening to this. It might be years away. So you've got your strategy and you carry on implementing it. I'm not acting any different today as I was 3 years ago, 5 years ago. 10 years ago, perhaps I was being a little more greedy. I took money out of my bond and the like, and that's what market crashes facilitate you. It's a sale. If you've got excess money and you can afford to put it away for 10 years, it gives you opportunity. In the meantime, you just carry on buying.
Okay, and perhaps bringing it back now to SA, we've also had, in the last week of August, so I think on the 29th, we reached, so coming off the high in Jan, when we crashed not crashed, but came down very spectacularly from something like, what was it?
60,000.
It was just above 60,000.
Yeah.
And then we hit that 60,000 mark again on the 29th, but very, very briefly, and then came crashing down again. Well, not crashing. Maybe I should pick my words carefully. We mellowed down quite a bit. But, that was a very nice surprise, I think, and especially considering how very stagnant the market has been over the past couple of months, and trading volumes have been very poor. What contributed to that, and can we expect more of that?
Look, we've been going sideways for 4.5 years. We hit a high late last year just before Nasdaq pulled back. Nasdaq, we rallied, pulled back, and then, as you said, the January and then down from there. So we've pretty much been going. So our market hit sort of the bottom of, so about 45,000 literally 4.5 years ago, early 2014. But this year more so, and if I'm looking at the top 40, because that's my reference index, because I can trade the futures on it, we have since February been trading between about 49 and 52,000, which is about 3,000 points, which is about a 6% range, which is an immensely tight range. And we move up and then we go down, and we've just gone sideways for those 6 months. What we saw last week was a break out of that. Suddenly, markets rallied higher. Everything was lovely. We moved nicely higher. We have now come back to the top of that range, helped in part by what Trump says were off-the-record comments around 200 billion more tariff penalties, whatever, going on to China. And we came back, as did Asia, Japan, much of Europe, as did not the US markets. They did quite nicely.
Continued.
and they continued their moves higher. So what we've seen is a market for us that's done nothing. We have seen a currency. When President Ramaphosa did his his cabinet in mid-Feb, we hit 11.55 as he was talking. And as I checked a moment ago, we were at 14.85. we were strengthening, and that's now reversed. But the currency story and equity markets generally, emerging market equity markets, are very much not a South African story.
Yeah.
And I know there's a lot of talk out there that President Ramaphosa hasn't done anything. Truth, 6 months is not very long. And truth is he has. We have the commission going on right now. In fact, we have loads of them. We got last week an energy policy that does not include $1 trillion on nuclear, which we A, don't need, and B, can't afford. There's a lot happening, but it's happening slowly. So we've been a victim of emerging markets, driven predominantly by South American and Turkey. Your Argentinas of the world, Venezuela, although they're really so insignificant these days, and then Turkey, which has its own political, economic issues lurking in it.
Just to throw something in, Simon, perhaps also the very fake newsy tweet Trump or series of tweets Trump hurled at South Africa regarding farm murders and all sorts of things. So that previously I hadn't even thought Trump would even venture this way, and now it's suddenly become sort of like an area of, oh snap. So it didn't affect the market much, but...
Yeah. The market didn't respond. The key thing is, so Trump's doing what politicians do, which is deflection, right?
Yes.
You get accused of something, no, but look over there. The point is, life was much better when we were under the radar. This morning I was preparing for a TV show, and I'm looking at international news websites, and there are 3 stories about South Africa, and all of them are, there's an historical story about nationalizing our Reserve Bank, which is really neither here nor there, in truth, but this is a fairly historical story. It did bring us a bit into the radar, but no self-thinking person, I think, be it politician or investor, took Trump's tweet massively seriously. But it did bring us. Before that, the emerging markets, we were just sort of, auxiliary
carried
damage.
By
that did bring us up a bit. And the problem is, and particularly with our currency, which is why we hit 1551 overnight one Monday morning out of Japan, which is, trades that are happening 3 o'clock on a Monday morning really aren't significant, except they do reflect on the charts, of course. And the thing is that we are the most liquid emerging market currency in the world. And if and what traders are doing, and they're sitting on the trading floors in Tokyo, London, New York, Sydney, wherever, and they see the lira getting killed, and they're like, oh, I missed the lira. Oh, the ZAR hasn't moved. And they all pile into the ZAR. And in part, that then becomes a self-fulfilling prophecy. But in part, we've just got that liquidity. And we are an emerging market. As much as we bundle together, we say developed markets. And then, yes, we can nuance down. Japan broken for 30 years. Europe, bubbling along, doing okay. But, US doing great. But then Canada, truthfully, don't know. Don't know.
No one pays attention.
And even if we start pulling Europe apart, okay, Germany's strong, France not sure, Scandinavia, honestly don't know. We like, as humans, nice little buckets. So we've been going sideways. You always break out of a sideways. It looked like the break was up. I think it. I look, and I'm talking my book. I hope it is, because I own shares and everything else. But if we're looking forward, and we've said this before in this podcast, is that South Africa under President Ramaphosa is a fundamentally improved place to South Africa under President Zuma, and it's just that isn't a switch you flick.
Yes.
Things are going to happen slowly. There's sort of a lot of stuff that needs to come through. We've got petrol prices hurting us. We've got inflation benignly coming back a little bit. We had the VAT increase, etc. It's tough to turn this place around. To my mind, the underlying fundamentals are there. I think we can. There's always risks, but there's risks to everything. My biggest concern, and this will so break my heart. We've had 4 years of sideways, 4.5 years of sideways. At some point, we start our own bull market, and the US collapses, and then we get dragged down with it, and we just miss out on the bull market, and it just never happens for us. And I hope to goodness, that is a possibility. It has to be one of the potentials on the market.
Let's hope it doesn't happen.
Yes.
And perhaps now turning to individual stocks, and we've had its reporting season, so results season, and they're starting to trickle in. And Woolworths, Shoprite Woolworths perhaps not quite that surprising, but still shocking nonetheless. And Shoprite perhaps more surprising to the market than Woolies. Woolworths profits down 15.3%, quite a big operating profit, quite a big drop. So CEO leaving, Ian is leaving, or well, he's there, but he will be leaving once they've found somebody to replace him. It doesn't seem like they're gonna pull out of Australia. So, you know, they've paid a lot for it. They might as well see it through. But I think a lot of the market is also feeling a bit restless and a bit annoyed with the Australia story.
So disclaimer, I own both. So there comes a point. Let's touch on that leaving. So they paid 20 billion. They've written down a third of it already, which at least they're now admitting means that they were wrong. A year ago, Ian Moore was saying, no, he didn't think they'd made a mistake. It's like, which part of you've written down a third? Anyway, there comes a point, and Famous Brands, another stock I own, went off and got indigestion in the UK and are now reading between the lines on their cautionary, looking to potentially exit. And I think, you know, Discovery did it. They spent a billion ZAR in America and decided they couldn't do it and pulled. Typically, you stay too long and you just pour more money after good after bad. And my view is rather cut and run quicker. The trick is, it's not just that who could you sell it to at what loss, is that can you sell it? I mean, that's the bigger issue. I'm a big fan of...
Who wants it?
Yeah, making mistakes are terrible, but compounding a mistake is perhaps even worse. But if we look at Woolies, so you're right. David Jones, we didn't expect the turnaround. Food was good. Mm-hmm. To me, the problem is, I mean, aside from the issues at David Jones, which they say they will fix, and let's hope they do, and in truth, in time they will, just at what cost and what margins. Clothing. They again have had problems with their clothing lines. Yeah. And, you know, we must remember that Woolworths was clothing, and then food was like this crazy idea that they had. And
now food is the main...
And now food was more revenue than clothing, first time ever. They again got clothing wrong. And I get that clothing is difficult and complicated, and Mr. Price has had stumbles on clothing in the past as well, and fashions and competition from Zara and H&M, and I get all of that. But if half of your local revenue is clothing, you know, it's just that I don't remember when last clothing really worked at Woolies. It's been 3, 4, is it maybe 5 years since they've really had a great performance from clothing. They've been carried by food. And so whilst David Jones is of concern, I think clothing is the bigger issue. Yeah, David Jones they can get rid of. They can sell it. They can admit they were wrong and it'll be expensive and horrible and everything else. They can't get rid of clothing. They've got to fix it. And apparently they are. Unfortunately, we've heard this story from them before. So that's what concerns me with Woolies. Shoprite doesn't bother me. So the results were down, first time in this century that they've had HEPS go down. You know? But there were a couple of points. So there were some issues around rampant hyperinflation, and there's IFRS controls around that. They've in the previous years benefited, and this year it hurt them. One of the things that hurt them is that the inflation in the products that they sell, food in South Africa, was sub 1%.
Yes.
Now
so deflationary.
Yeah. Your other costs are, you know, which is staffing, rentals, administrative services, electricity, all of those sort of things are not running at sub 1%. They're running at 4, 5, 6, 8,
electricity
10, 15.
Way higher.
Yeah. So what happens is that your costs start to run away from you in terms of because of that deflationary pressure or very modest inflation on the food that you're selling. Yet they still managed to bring their margins in at 5.5, which for them, operating margin at 5.5 is down. They've been as high as 5.8. But it's also way better than Pick n Pay's 2.2, 2.4, I think. We've talked before how under Richard Brasher the operating margin is unchanged in the 4 years he's been at Pick n Pay. So this is, in Shoprite's case, evidence is that this is a blip. This is everything going wrong at the same time. But they remain, to my mind, if you're going to own a food retailer in Africa, if you're going to own a food retailer on planet Earth, Shoprite's the one to own. Yeah.
Okay. Now, two very interesting stocks that we're going to bring up next. MTN. So MTN has been through, as the children of the internet say, the most. Nigeria just keeps coming back and stinging them and stinging them and stinging them. High earlier this year, Jan, 139 Rand and 53 cents. Low for the year on the 30th of August, 86 Rand 50. That's like the lowest since 2012, I think.
I think 09 maybe 09. Even.
Yeah,
goes back a long way.
It's been a while. And I neglected to check the chart before coming through. But it's been some pretty tough times for MTN in Nigeria, and perhaps unlike with Woolies and David Jones, where they could just say we made a mistake, let's leave. This is their biggest market, so they can't just be like, deuces, we're out.
They can't just exit, and I mean their share was 260 4 years ago.
Mm.
So we all know about the big fine in 2015.
Yes.
To MTN's credit, this time in 2015 they only issued the cents at 2:30 on Monday afternoon. At least this time they got it out ahead of market open, which is just 101 being a listed company. But this new fine is complicated in a couple of issues. There are accusations out there that the Nigerian government is essentially doing a shakedown on MTN. They've got elections coming up and $8 billion US. I mean, which country wouldn't like $8 billion US? And that the Senate had done an investigation in Nigeria, which is the upper house of parliament, and declared MTN free. A couple of points on that. Firstly, just because a parliament says something, I mean, with respect, our parliament said that there was no problem with Nkandla, and they were wrong, as the Constitutional Court then said. Is this a shakedown? We don't know. We just don't know. Unfortunately for MTN, this is the period 07 to 2015, which is exactly the same period of the previous fine. So it's the same previous management. It's not the new management, it's the old management team. And therefore, everyone, it's like, you guys have been caught before, and we just don't know if this is or isn't. Also, then the story is, well, surely if they did it wrong, they repatriate the money and then they take it back out again. This isn't a fine as so much as it's returning
just bring it
the
back
money.
And
Yes, no, maybe. We don't know. I mean, also think about Iran. They've got money stuck in Iran. So maybe the 8 billion goes back and gets stuck. And to put it in perspective, their market cap in dollar terms is about 11 billion. So that's a big
chunky
slice of their and it just, I held MTN shares, and when the disaster happened in 2015, I sold at about 170 odd and never looked back. And there's a second tinge to it, broadly around the telco business model, which I think they're ultimately going to become utilities, high yield, low margin, high yield, dividend yield utilities, but they're going to go kicking and screaming into that.
Yes.
And I want to wait until they have. But we just don't know. And the worst thing for an investor is uncertainty, is not knowing what the story is. And even if it's a shakedown, you might still lose. And then it might not be a shakedown. They might actually have breached rules. They might actually be in breach, as it was with their previous fine, which started at $5 billion and ended up being under two. So it might get revised downwards. But again, it's going to be a couple of years of uncertainty and concerns whilst this sort of plays its way out.
Okay. And perhaps Tiger Brands is the last one we'll touch on. So Listeria update today from Minister of Health, Mr. Aaron Motsoaledi, and we're Listeria free. I saw many people on Twitter going, "Oh, I didn't realize we'd actually stopped eating polony," which for me is a very interesting thing to sort of
the guy down the road from me, no quarters for at least a week, but then they were back quickly.
They were back, yeah.
How do you do a quarter without polony?
I was like, I feel like, the market has one story, but the rest of the country was like, we need... The quota needs to keep going, so polony won't stop. But Tiger Brands had a trading update a couple of weeks ago, also expecting HEPS down between 22 to 37% and a whole lot of other metrics. So obviously one of their facilities has been closed. That's where they found the strain of Listeria, but they're expecting that facility to be open again in the new financial year. So their financial year ends on 30 September. So from October, they're expecting that to be operationally sound. Apart from that, I think Tiger Brands has experienced other issues, pricing, price wars. So Tiger Brands has several brands across their portfolio. I didn't realize just how
It is
involved Tiger Brands is in my life until I opened my cupboard and actually realized almost everything in my house is Tiger Brands, except they're glass bottled goods because they're expensive. So, that's where we opt for your RCL alternatives. But, we're in a very tough, consumers under pressure. We've seen that coming through with retailers, and we spoke about it, perhaps not so much Woolworths, but Shoprite certainly. And that's where Tiger Brands would push most of their brands. What is the outlook? What are your thoughts on Tiger Brands and their outlook, given that the listeria is over? We're expecting that plant to. So I'm expecting many analysts or the market has largely discounted that those earnings, and we've pulled that out, but we're expecting that back. So where could Tiger Brands be heading?
Yeah, so that update had a lot of one-off moving parts.
Yes.
As you said, the plant closures in Polokwane and the like. And they've still got a potential class action suit, Richard Spoor's leading that, although they have insurance for it. How that ends up, and I don't know how much does insurance pay? Does it pay all of it? We don't know those T's and C's, but let's assume that's all one-off. They've got two things that are hurting at the moment. One is we're seeing some soft commodity prices increase. Maize and wheat picking up a bit. They're not as exposed to that as perhaps a Pioneer, but certainly they are exposed. They do bread as a component.
Grains is their biggest business.
They've got some bread business, but it's mostly grains, which is also again picking up. There's talk that we might have the opposite of El Nino, whatever it is, and we might have some drought coming through again next year. So those are all weighing on them, and it's been weighing broadly on the sector. We can see it in AVI, we can see it in Pioneer Food Group as well. Perhaps one of the bigger problems for Tiger Brands is, notwithstanding the breadth of their catalogue, and as you say, you could literally live on their food for easily.
All of it.
That could be your diet for a month. You could just shop Tiger Brands. And shareholders maybe should, but a lot of their stuff is the top end brands, and I think Ginger Biscuits as a random example. They make the classic ginger biscuit. I'm not a biscuit eater, but it's a very nice ginger biscuit. But it's also a premium ginger biscuit in terms of price, and there's a no-name brand and there's a cheaper one. Now, that no-name brand one might be the Tiger Brands. I mean, we don't know where Checkers and Pick and Pay source their no-name brand. Yeah. But consumers having a tough time of it, and you don't want to give up your ginger biscuit, but you do perhaps shop down at that price point. And I think that's what we're seeing amongst all of the other problems out there. In that space, I mean, my preferred is typically AVI in terms of they've got some shoes, they got rid of some. They got fishing. Fishing's weird because diesel's your big input there, and that price hurts. They're going to offload I&J in time, I suspect, but for now they've got it. And then they've got what they call their snacks and the like. But it is, I've always, as an investor, I don't want to be the person making the biscuits. I want to be the retailer, because the retailer has the pricing power. Shoprite, Pick and Pay, Spar, Massmart, whoever your food retailer is. Massmart very little, but some there with their brand. You're seeing what your customers are buying. You're getting less of the top end brand and more of the bottom end brand, and you've got more pricing power. You say, no, we won't take that price. And if you're a Shoprite and Tiger Brands wants to do a price increase that you think's unreasonable, you can dig your heels in because you're a Shoprite. You're the biggest customer in the continent. Now, do you? I don't know how those conversations go down, but I've always been of the view that I would be a much comfortabler owning the food retailer than the food producer. We have a drought and prices go up, and Shoprite just passes them on to their customer. And in truth, high internal inflation is great because you can wiggle in a little bit extra and squeeze your margin a little bit higher, and the consumer will never notice type of scenario. Whereas your food producers, under the caution, on the verge of losing money or seeing earnings absolutely getting decimated. So I've always said, the food manufacturers, we need them. Yeah. I never wanted to own them. I absolutely don't. Tiger Brands in particular, the share price is looking weak, and if we don't get a drought, this will be their worst set of results. They'll come through financial year of September. Those will be released in late November, December, and things should then improve going forward next year. This also assumes a uptick in consumer confidence. Not a ragingly confident consumer, but an uptick. If a drought comes next year, Pioneer's going to be really hurt, but Tiger Brand's going to be under pressure at the same time.
Okay. Simon, thank you very much, as always.
Always a pleasure.
And let's hope September is very springy for
And
the
boring.
market. And boring. We need that. Once again, thank you very much for joining us on the Long Short podcast. If you have any topic suggestions you'd like to send through to us, please send them through to securities@standardbank.co.za. Alternatively, you could drop your suggestion in our community under the talk section. You can also tweet us at SBG Trader ZA. Thank you for listening and goodbye.